Things you should know about the One Big Beautiful Bill, Part 2. So for the first time since 1986, car loan interest is now deductible, but it only impacts certain people. This was billed as no tax on car loan interest, but it's not necessarily a blanket statement. Here's who it impacts. So this deduction applies to people who purchased new vehicles. The final assembly has to occur in the US, so not just US brands. It could be really any auto brand as long as the final assembly occurs in the US. The loan has to be originated January 1st, 2025 or later. And then as always, there's a phase out mechanism. This is where it gets interesting. So in scenario number one, it's a single taxpayer. They have an MAGI of $85,000. They meet all the requirements to take the auto loan interest deduction. They pay $2,300 over the course of the calendar year, let's call it 2025, in interest. And the taxpayer receives, in this scenario, a full $2,300 deduction. This means if they were, say, in the 22% tax bracket, this could reduce their tax bill by up to $506. However, if we look at a slightly different scenario, let's say there's a single taxpayer, modified adjusted gross income of $110,000. They meet all the requirements. Like in scenario one, they paid the same amount of loan interest at $2,300. $2,000 of the deduction is actually phased out, leaving just $300 to be deducted because they're over that phase out threshold. That taxpayer in this scenario only receives a $300 deduction. Given that this person would land in the 24% tax bracket, this would only result in a $72 federal tax savings. Now, for next tax season, regardless of whether or not you think that you're going to be impacted by this, we're still going to encourage all clients to take a look to see if they have supporting documentation and determine whether or not they're going to benefit from this. So lenders are going to be required to provide statements if you pay interest over $600. They'll provide those by January 31st of the following year. You'll also have to report the VIN number of the vehicle on your tax return to receive the deduction. Now, this particular deduction is only temporary. It only applies to tax years 25, 26, 27, and 28. One of the cool provisions is that motorcycles actually qualify, and this is also referred to as an above-the-line deduction, so it's also available to people that do not itemize, essentially able to be deducted by people that take the standard deduction as well. Please follow JMCPA Plus for more information on the One Big Beautiful Bill.